Welcome to a video that I like to call the deep dive video. Now, I use the term deep dive in a bit of a different context. Every week, I do a number of videos. I do a video each day. I do a video each week. I also do an intermarket analysis video. And the last video that I prepare for the week, I go through and I look at all of the daily charts and I pick out those charts that I really didn't talk about maybe one or two times, or maybe I didn't even hit at all. I also have a number of different charts that I don't show in any video. So I take all of these different charts and put them together into this video because sometimes we can get some insight or clues by looking at these other charts. This is being prepared for Monday, December 11th. The first chart that we look at is a chart of the VIX, and this helps us to measure sentiment in the market. When the VIX is high, it's time to buy. That's because stocks have been going down. When the VIX is low, it's time to go. That means it's time to sell because stocks have really been going up. Typically, with the VIX, you use a static range, 12 to the downside, 20 to the upside. But the VIX is more dynamic than that. It doesn't always stay within that nice, neat little range. So what we do on this chart is there is a VIX on this chart, but then it's turned invisible. And then on top of that is a 50-period exponential moving average. And we can see over a period of time that there is a range that will develop. Sometimes we go much higher from 20 up to 40. Sometimes we drop down to a lower range. Then after the COVID plunge, we went back up to a higher range. And over on the right-hand side, we might be dropping down and starting to develop a lower range. We don't really use this to make decisions. This just gives us some information about the market. Then we also want to see how fast is the VIX actually moving. And to do that, we plot a 9-period RSI. We did get an extreme reading earlier in November. That means that stocks were going up pretty far, pretty fast. Well, since that time, we've been able to work off that reading. And even though it's still pretty low, it's not giving us an extreme reading right now. So I haven't been showing that chart. Then sometimes the VIX doesn't really help us all that much. There's a lot of different sentiment charts that I use. Another chart that can sometimes be helpful is a correlation between the VIX and the S&P 500. That is the middle chart here. And when we really spike up, something is usually going on that maybe we're not seeing with some of our other charts. Right now, we're getting a very low reading, which is why I haven't been showing this chart. Then we look at the MOVE index, which measures the volatility of bonds. And they've been moving around a little bit more lately. You can see just by looking at the chart itself, where the volatility of stocks, which are the VIX, is the VIX, that has really been going down. And so we plot the S&P 500 on red. It's in red down below. And then the spread between the VIX and the MOVE index, and it has been coming back down because the volatility in stocks has really been dropping off. I also keep an eye on the correlation on the bottom, and they're not having a real strong tendency to go in the same direction right now. The higher the reading, the higher the correlation. Now, it doesn't tell us if they're going up or down. It just means they're going in the same direction at the same time. We also look at the skew index, which is a slightly different way of measuring volatility in the market, where the VIX uses at the money options. The skew looks at out of the money options. And we did have a reading up into this red area, and then we started to drop down and the market continued to go up. Well, there are times when you can see a spike here when it might mark a continuation, it might mark a top, it might mark a bottom. Right now, we're not getting an extreme reading, so I haven't been including this chart. Then we keep an eye on where are we from the all-time high. We're getting a little bit closer now. The S&P is down 4.45%, going back to the high set in January 2022, and we're coming back and testing this previous high right now that we set earlier in 2023. Stockcharts.com comes out with these automated technical alerts, and we read these from the bottom up. When they're red, they're negative. When they're blue or green, they are positive. When we're having up days, we tend to see a lot of blue or green. When we're having down days, we tend to see more red. And this looks at the S&P, other indexes, other markets, other sectors. And by just looking at this, we can get an overall big picture view of what's happening in the market. For example, in Friday's session, we ended up going higher in that session. So we saw a lot more positive signals being generated. Then we look at five main indexes. Now, for myself, it's the S&P 500. That's the core index that I look at. But we look at other indexes too. We look at the Dow, we look at the NASDAQ 100, we look at the mid caps and the small caps. And Stock Charts has this tool to rate them on a score from 0 to 100. 100 being a low score, 0 being a low score, 100 being a very high score. And coming in first place, which has been in first place for quite a while now, are the QQQs, which is the NASDAQ 100. They're coming in with a score of 91.1. Now, we're seeing a little bit of surge with the 30 stocks that make up the Dow, and that is the diamonds, the ETF for the Dow Jones Industrial Average. And it's showing an improvement with its score coming in at 87.7. In third place is the S&P 500. It had spent a lot of 2023 being in second place behind the Qs, but it's still looking okay because there are a lot of stocks that make up the NASDAQ 100 that are also included in the S&P 500. And this score comes in at 80.5. The mid caps are showing some improvement as well, where they have been quite a bit weaker earlier, just a month or two ago. They're coming in at 64.7. And then in last place are the small caps. They're also showing some improvement now. We got down into the teens when we were really having some difficult times. So we are coming back up and we get a score of 59.1. There's this thing called the January effect, which around the middle part of December, historically, small caps and to a degree mid caps might often see some real favor and start to go up. Now, there's no guarantee that that is going to happen, but historically that has happened, and maybe we're seeing some improvement with this overall technical score because the market is anticipating that happening again. We look at some short-term charts. The first chart is a short-term rainbow. We go from 10 periods up to 50 periods, and I look at this whole chart together. I try to take the whole big picture. And when we're above all of the lines and going up, that's, of course, much more positive. Since we have been going up, excuse me, these lines are starting to flatten out and actually break away from each other and produce more lines rather than a jumbled mess that we were seeing earlier on. We also look at a double and triple exponential moving average based on 20 periods. That's the green and the blue line up here. And we have been going up and showing a lot of an improvement here, but nothing's really happening. So I haven't been including this chart that we're not necessarily seeing in other charts. We look at a regular study of a simple and exponential moving average based on 20 periods. We are above that moving average. This is a short-term measurement that I use. And we're seeing where the red line is now coming back above the blue line because that tends to denote that the strength has been pretty good, but it might be wearing off a little bit. The blue line tends to move faster than the red line because it's an exponential moving average. So more of the calculation is centered towards later prices, where with a simple moving average, all 20 periods are counted the same. So as we've been chopping sideways, we're seeing that weakening a little bit. If we can see this blue line come back and go back above the red line, that would turn things more positive, meaning that we're actually starting to move. We have a moving average study, and I use this like an oscillator. Here's a 20, 50, and 200 period moving average study. When we start to break above these blue lines, that means that we've gone extreme positive. We're close, and if we have another update, we might actually start to get some extreme readings. These have been coming on and falling off of the daily videos as we've been going sideways. We also have the boom indicator. This measures how far away is price from a moving average. The top area is a 20 period moving average. Then we have 50 and then a 200 period moving average. Because when price gets too far away from a moving average, it tends to act like a magnet and snap back to the moving average. We had become a little extreme in the short term looking at the 20 period. We're showing some improvement with the 50, but we never became extreme, and we are chopping sideways to showing some improvement with the 200. Some intermediate term charts have another rainbow going from 50 periods up to 100 periods. Also, we're breaking above all the lines in the rainbow, and they're starting to turn back up. So this is showing some improvement. Bollinger Bands are very popular. There's a number of ways that you can use these. I look at, are we above or below the midpoint of the Bollinger Band? Are the lines going up or down? Well, they're going up and we're above the midpoint, so that's positive. An indicator that we can use is called the percent B indicator, because there's a very brief period of time when we might close above or below the Bollinger Band. We're not doing that right now, so we're not getting any kind of an extreme reading. But we can look at the percent B indicator to say, okay, we're above the midpoint and we're going up, so this is also more positive. We look at the S&P 500 and then take an anchored moving average going back to the all-time high, and we continue to be well above this. We're far away from this line, so I haven't been showing this chart. We look at the Carner's RSI, which is a momentum oscillator. We can also use this for overbought and oversold conditions like a regular RSI. When we're above the midpoint, that tends to be positive. Below the midpoint, we're negative. We're not getting any kind of an extreme positive or negative reading, so I haven't been including this. Then we have the double and triple exponential moving averages based on 50 periods, which is more intermediate term. And we're seeing the red line above the blue line, and we're seeing price above both. So this is suggesting that things are moving in a positive direction. Then here's a regular 50-period moving average study where the blue line is above the red line and price is still above both of the moving averages. We're kind of far away, so I haven't been showing this chart. Then we get kind of intermediate to long term when we look at a 100-period moving average study, and we're well above both of the moving averages, so I haven't seen a need to include this chart. Then I mainly have been showing the summation indexes. Whenever the reading for the S&P McClellan oscillator is above 0, the summation index goes up. If we drop below 0, then the summation index goes down. This is a shorter term type of indicator that we use, and it can give us some extreme readings, either positive or negative. Well, after giving us an extreme reading, we've been falling back, and we're still positive because we're above 0. But since we're not really moving all that much and we're not getting an extreme reading, I haven't been including this in the chart. I've just been showing the other chart that goes with this, which is the summation index. And I can say the same thing here with the NYSE McClellan oscillator, or the S&P is a specific index. The NYSE is a broader measure of the market, and when we're above the 0 point and usually going higher, that tends to be more positive. We have the CMB composite, where we use this like an oscillator, showing an extreme positive or negative reading. We were extreme positive for most of the month of November, but now we've been dropping back down. I typically will just show this when we get an extreme positive or negative reading. Then we keep an eye on how far away are we from the 200-day simple moving average. We're green and going up, so that's more positive. We'll see if we can continue from this point. We have standard deviation. This doesn't measure direction, it measures speed. And as we've been chopping sideways a lot, we've seen this standard deviation really start to go down, showing that there's not been a lot of movement in stock prices. We look at the Copic curve, which when the black line is above the red line, that's positive. We're now dropping below. I mentioned this in the daily video, but I don't show this chart. I may bring it back up again if we turn more negative with the market environment. The Pring bottom fisher, typically we only look at this when the black line crosses above the red line, and we've been chopping around a little bit. Well, now the black line is below the red line, so that a signal's not being generated, so I haven't been showing this chart. Then we keep an eye on the S&P 100 and compare it with the S&P 500, and they're still looking pretty much the same here. They were getting out of line here for a few days, but we seem to be coming back more into conjunction with each other. Then this just measures, and I put these lines on here myself, so they may not be exact percentages. We have the all-time high over on the left, and then we hit the low in October of 2022. Then we saw the rebound, and we hit a top in July 31st of 2023. And then we were running into some problems. We seem to have hit a low, and now we're starting to come back up and test this previous high. And this just gives us some percentage ideas of how much things have moved. Here's a 50-day cycle. Sometimes this seems to help. Sometimes it does not help. We're pretty much in the midpoint of the cycle right now. Then we have a point and figure chart, which does not take time into account. If prices are moving up, that produces an X. If prices are moving down, that produces an O, no matter how long it takes. And we don't have any new X's or O's that were drawn in the most recent chart here. We did get a reading on November 20th of a double top breakout. That's positive. And for the time being, I haven't been showing this chart because we haven't been seeing anything new being generated. Then we have the mass index, which we only pay attention to this when we get back up to the red dashed line and the blue line, and we're far away from that now. Some long-term charts. Here's a rainbow going from 50 periods up to 250 periods. We're above all of the plotted lines on this chart and looking more positive. Here's a longer-term moving average study. I have a 50-period moving average study on the top. That's mainly for reference, then a 150 and 200. And we're not getting an extreme reading, but we are turning back up, and we're above the 250 reading, so that is more positive. Here's the daily special K chart. We don't get very many signals from this, so I mention this in the daily videos, but I don't really show the chart all that often. We are rolling over as the market has been going more or less sideways, but we're still above this red line, so we continue to be positive. And then here's a weekly chart of the S&P 500 and an arithmetic scale going back to 2009. We're well above this line, so as long as we're far away from that, I haven't been showing this chart. Then we look at a weekly chart of the S&P on top, and then in the middle is the weekly chart of the German DAX, and we see that there's a pretty strong correlation between the two. If one is going up, the other one tends to be going up. If one is going down, the other one tends to be going down as well. So we can keep an eye on what's happening outside of the US to sometimes give us some clues. Then we look at the 10-year yield and subtract the German 10-year yield, and that gives us a line. And when it's above zero, that's positive. That means US rates are higher than German rates. But what's interesting about this is in the middle, we can plot the US dollar index and then see that there's a pretty strong correlation between these two. When this is going down, that tends to be positive for stocks. When this is going up, that tends to be more negative for stocks. And down on the bottom, you can see the correlation isn't as strong as it was, but they're still having a fairly strong correlated relationship. Then we look at some different support and resistance levels. This is a chart that I was showing for a while. We're far away from any of these lines right now, so I haven't been including that in any of the videos. This is a parallel line going back to the all-time high and then the lows set back in 2022. When we were coming up to the underside, this did act as resistance. Well, we've been able to break above this, and we're far away from that line right now, so the chart really isn't helping us for the time being. Then we take the low that was set during the COVID plunge and the all-time high that was set in early January 2022 and just break these into 25% chunks. We're kind of in between the 75% chunk and the 100% chunk, so I haven't been showing this chart. And we're seeing a lot of that now with our Fibonacci charts. We've retraced more than 100% with this short-term Fib chart. We're in no man's land with a longer-term Fib chart. Also in no man's land with this even longer-term Fib chart. Looking at the NASDAQ 100, we're above the 61.8% retracement and have quite a ways to go to get back to the 100% retracement. Then another indicator takes the simple moving average based on 20 periods of the open, high, low, and close. We're well above this little mini rainbow here. So I haven't been showing this chart. Now, it is positive because all of these lines are going up. If we start to see things fall, sometimes one of these lines may end up acting as support. Then we have the Ichimoku cloud, where it took us quite a while to get through the red cloud. Now we've been able to break above that. Also looking out into the future, we are turning green. Now, all this is just a series of moving averages that are then shifted forward. But sometimes these can be pretty helpful support or resistance levels. But since we're far away from the cloud, I haven't been showing that chart. Then here's another Fibonacci chart with the NASDAQ 100. We're above the 61.8% retracement level and still have a ways to go to get back to the 100% retracement level. In the financial sector, which has been doing fairly well lately, so I haven't been showing this chart because we're well above this support level. Some broad market measures, we look at the Vixen, which measures the volatility of the NASDAQ 100, and it is also continuing to go lower. Here's a weekly chart of the QQQs going with an anchored moving average, and we're well above this line, so why show the chart? Then we look at the regional banking ETF and compare it with the financial sector, and both of them are starting to see some improvement. They're still in a downtrend, but for the first time in quite a while, they're actually breaking above both of the moving averages. If they can continue to go up and at least stay above the blue and the red line, we might eventually see a golden cross with this ratio. We keep an eye on the QQQs to the Dow ratio here, and we're seeing that they're having a pretty strong tendency to go in opposite directions. The Dow's been doing quite well lately, where the Qs have been under a little bit of pressure as of late. But typically these will tend to move in the same general direction. We're just seeing kind of an anomaly right now. Then we look at TIPS, which are Treasury inflation protected securities. That's what people get into when interest rates are going up, because you can adjust the interest rates and their shorter maturities, and you can roll over into the next higher level. Well, when interest rates top out and start to come down, that's when folks tend to get in longer term bonds. And we can see now that this continues to go down. That means that inflation worries or expectations have been subsiding. We can look a little further out too and look at those same tips and take a ratio to the 7 to 10-year bond. This has been really coming down. And so we're seeing less inflation worries. Now, you can see right over here, there's a little blip up. In Friday's session, we had a pretty strong employment report. And on Thursday, we had a pretty strong weekly jobless claims report. We're wondering, is that just something that is going to happen one or two times, or are we starting to see a trend develop? If more inflation worries start to come into the market, we'll see this ratio begin to go back up. If inflation worries seem to be under control, and we're going to get a lot of inflation data in the upcoming week, we should continue to see this ratio going down. We'll look at home construction, which is very sensitive to interest rates, and compare it with bonds, and the home construction is really outperforming bonds. So that's looking fairly healthy. Some rate of change charts based on 250 periods. We look at the close on Friday and compare it with 250 periods ago. We are showing a little bit of an improvement on this chart. We also have the same chart going back to 1980, which is showing a little bit of an improvement. Keeping an eye on bonds, we compare stocks with bonds with each other. When this is going down, that means that bonds are underperforming stocks. We look at the broad market and compare it with bonds, and this is showing that stocks are on a broader market basis are outperforming bonds. We look at the QQQs, which are outperforming bonds as well, and the Eurozone. So we compare European stocks with US bonds, and this is showing that even European stocks are outperforming US bonds currently. We look at the relationship between the S&P 500, which is in red, and the blue line, which is the long-term bond ETF. And longer term, they're having a tendency to go in the same direction. They had a stronger shorter-term relationship. It's improving a little bit, but it has been dropping off lately as stocks have been going up with bonds going down. Then looking at the QQQ and measuring that against the long-term bond ETF, they do have a pretty strong correlated relationship. And then we keep an eye on the yield curve, the 10 to the 2 and the 10 to the 3 month. Those are the ones that most people watch. I post or track a couple of other yield curves that aren't necessarily as important, but both the 2-year and the 3 month to the 10-year, they continue to be inverted. We look at another broad market as measured by the S&P 1500 and compare it with short-term bonds, showing that stocks are outperforming bonds. And the tech sector is also continuing to outperform bonds as well. Then we look at cash and compare it with bonds, and this is starting to come back down just a little bit. As when this is coming down, that means folks are more confident that interest rates might be done going up, and so they've been coming down, even though we saw a bit of a spike in Friday's session. Then we compare shorter term bonds with further out bonds. When this ratio is going down, folks are more certain about interest rates, but we did see the spike up in Friday's session. Then we look at intermediate term corporate bonds and compare them with 3 to 7 year government bonds. And the corporate bonds are continuing to outperform, showing that there's more confidence in the economy. Then we look at kind of an inverse where we take longer term bonds and a ratio of shorter term bonds. And this has been going up lately, meaning that folks are a little more confident that interest rates may be close to topping out. Then we look at the S&P 500 and compare it with a Treasury bond ETF. When we're going up, this means the market is focused more on a soft landing. If we were going back down, see how we were going down over the summer. And if we were to really start dropping, that means that the market thinks there'll be a hard landing. A soft landing is when we have economic slowdown without going into a recession. A hard landing is economic slowdown and a recession occurring. And then some possible positive scenarios. These can be useful. Usually they're used to mark a bottom after we've really been declining, but we can see the overall health of the stock market by looking at some of these charts. This first chart is just the percent of stocks that are above their 200-day moving average that are in the S&P. We're above 50 and advancing, so that's showing some improvement. Then we take a shorter term study based on 50 periods for the S&P, and this is showing some improvement. We also keep an eye on the mid caps as well as the small caps. And then this is a study that I was showing for a while because we were starting to get to an extreme positive reading based on price. This is a 19-day exponential moving average of the advanced decline ratio of the S&P 500. And we are coming back down just a little bit now. We are positive based on volume, but we never got quite up to an extreme positive reading. So thank you. I hope you found this helpful. Please feel free to check out the daily videos, the weekly videos, and the intermarket analysis video. I hope you have a really good weekend, and I will talk to you in the next video.